Welcome back in, everybody. Well, when it comes to making your money work hardest for you, your assumptions about the future, they need to be realistic. Keeping a good eye on reality can actually lead to some big profits for you. Marshall Clay from the Welch Group joins us this morning to give us some analysis and perspective on this. Good to see you, Marshall.
Good to see you, Mike.
All right, so let's talk about what kind of assumptions, kind of break that down for us, because a lot of times we lose perspective on this if we just have a 401k that we don't pay a lot of attention to or whatnot.
That's right. So, when we make assumptions, we kind of know at the outset that most, if not all of them, are going to be wrong. But we use assumptions about the future to help drive our decisions, in the present. And so, when we're talking about the big boys, the big assumptions out there, you're really looking at, rates of return. We're really looking at how inflation is going to eat into your purchasing power. And there's other considerations as well, but those are the ones we're really going to talk about this morning.
Well, because we know that somebody could look at, say, a Warren Buffett and think, well, man, this is the approach I need to take. And by the way, he sometimes takes a conservative approach. But you're looking at an 8% return, and you're basing that on historical information, correct?
Correct. So obviously, I don't have a crystal ball, but just to give your viewers some perspective, if you look back over the last 10 years, the broader U.S. stock market has been up approximately 14%. But if you go back just another 2 years and you take into consideration that 2008, 2009 generational bear market, that average yearly rate of return drops down to about 9%. So you always want to give yourself a little bit of wiggle room. And so for our clients, we're assuming, particularly for the stock market, we're assuming approximately 8% rate of return, knowing that we may not be 100% right, but we want to give ourselves a little bit of wiggle room there.
So when you talk about inflation, we know at some point we're going to see it, start to see it. So when do you think we start to see it, and how much an effect can it have on us, and what should our approach be with inflation?
See, I think that's a big one that I think we're already seeing inflation. If you look back over the last 10 years, it may not have shown up really in the CPI index that the U.S. government uses to give cost of living adjustments on Social Security and things like that. But if you're a student that's attending college, or if you're someone who's been intimately familiar with the healthcare industry, you've seen a lot of inflation there. You look at real estate prices, a lot of inflation is being seen there. So when you're trying to factor in, you're trying to figure out how much it's going to cost for you to live the way that you want to live in retirement, you've got to account for inflation, because it can cause a dramatic increase in how much you need year over year. We're looking at around a 2% inflation expectation over the next 10 to 20 years, and that's going to drive your cost of living up probably about 50% over a 20-year time.
All right, and Marshall Clay's final note was to be more reliant on your personal savings and investing as you get closer to retirement age. That's also a good plan as well. Marshall Welch, we're out of time though. Marshall Clay, I should say, from the Welch Group. Thank you so much for joining us by FaceTime. We always appreciate it, brother. Stay safe.
Thank you, Mike. You as well.